Alright folks, how's it going? Well, as you can see, we've had a pretty flat week all round, and I guess bonds must have done quite well because Life Strategy 60 was the only one that was slightly positive. And as you can see, there's the historical data to show how badly I've been doing. I'm still slightly ahead of Life Strategy 60 for this year, but not since 2017 though. Let's have a quick look where that return came from. Well, there's the information. Does anything stand out? Montenegro European smaller companies stands out, doesn't it? No idea what's going on there. And REIT stands out. I mean, they had some results, which you'll see in a second. So, and then if we look at Fundsmith, there's the Fundsmith information. Bit of a comeback for Novo Nordisk, and nothing too out of the ordinary apart from that, really. There's an issue with Meta though, and the Google data. I've had to find this different formula from Reddit to get the share price. It just doesn't find any information, and I've had to just type that formula in to get the weeklies for Meta. But yeah, I don't know what's going on there. Oh yeah, so most of Novo Nordisk's change was on Friday. As you can see, 8.47% up on Friday. But yeah, good trial result apparently. But it's a very early stage trial result. So maybe they're getting a bit too overexcited. Or maybe last week's big fall in Novo Nordisk was them getting too unexcited or scared. Who knows? Anyway, yeah, there's the performance. And we've had a very dry spell on the dividends, £10.61. Can't even remember what happened here. Oh yeah, of course, yeah. So they've energised their big, I think it's an American battery site. I'm just checking because I don't remember seeing any particular, yeah. So Gore Street Energy have seemingly had some good news, but over the week they're down 2.41%. So yeah, you can never predict what's going to happen in this world of investing, can you? But yeah, they're talking about improved revenues and a successful energisation of quote unquote BlackRock. I don't think they are yet receiving revenue from BlackRock, but it's kind of set off. I think they mentioned it. Construction. Oh yeah, they're just talking about other ones there as well as other construction that's still ongoing. I think they mentioned somewhere here about when BlackRock. Oh, so it talks here about BlackRock project is expected to receive an investment tax credit of up to 30% of the capital expenditures. So yeah, who knows? I think there's a lot of doubt about whether Donald Trump will allow that to happen. But I think even if he doesn't want it to happen, it might legally be a bit of a difficult thing for him to do. Yeah, here we go. RA revenue will commence in June 2025. Now this big asset getting up and running and receiving revenue is kind of why they announced that their dividend for this year was going to come in kind of unevenly because they anticipated this big battery site getting energised or whatever. I don't know what the wording is. You see though, they've gone to 1p, and then in April there'll be another 1p, and then in July there'll be like what did I write it down as? 4p. That's what they're kind of hoping for. So in July is the 4p that's kind of scheduled, kind of penciled in, and revenues will commence in June 2025. Maybe that's why the share price is down, because I'm not sure that's long enough really, because if they're relying on this asset generating income to make that 4p dividend in July feasible, is starting to receive revenue in June early enough? I'm not so sure. But I mean, as I said at the time, I don't really care if we do get that 4p at the end. I've accounted for a 47% drop in the dividend anyway. In fact, it would be kind of useful for me, because what it would do is it would reduce this year's dividend so that that means that next year's dividend is a lower hurdle to jump over to improve upon, because I've got lots of I mean, it's just, it's just playing games really. It'd be nice to smooth out my dividend growth rather than have it all happen this year and then next year will be really bad growth compared. But yeah, it doesn't really matter either way to me. I'd be quite happy for them to pay me another 1p in July and then increase it gradually from there. I don't need the big bumper dividend. Yeah, and then I think there's other. I'll just scroll through it slowly, so if anyone wants to read it, they don't have to bother finding the link. You can just pause this video and read it for yourselves. There's other stuff in there as well. There we go. People familiar with this investment trust world might have heard about this Saba Capital. What are they called? Is it Saba Capital? Oh, I think it's Saba. I've heard people say, yeah, Saba Capital Management. They're just trying to take over 7 trusts. I mean, it's basically a he said, she said, he said, they said. Basically, they're saying these trusts haven't performed very well, so we're going to take over them because we're much better. And then they start arguing about time frames of doing well, and it's all very petty, But basically, I mean, to my mind, these trusts they're going after, the investors who invest in them, like me, it's similar to me in Scottish Mortgage because one of them is Baillie Gifford US. And you go into Scottish Mortgage, which is similar to Baillie Gifford US, knowing that it's going to do very well sometimes, it's going to do awful at other times, and that's just the nature of it. They've told us many times, when you watch interviews with the managers, going back for years and years and years, they've always said, even when things were going well, they've always said, we don't care about volatility. So this share price, the share price of our fund could go down a lot, it could go up a lot, and similarly for all of the underlying assets. And if you look at some of their long-term holds, they've had things like Amazon where the dot-com bust, it just completely cratered. But then they kept hold of it, and eventually it's that crater they had looks like a little blip on the graph long term. So it's to my mind, it's like the investors in these trusts should at least know what they're going for. And if it doesn't perform well now, it's up to them whether they want to keep holding it. They obviously can sell it, and that's obviously what a lot of people have done because they've gone to a discount to NAV. That's like an indicator of more people wanting to sell than wanting to buy. It's kind of like a flaw in the concept of an investment trust. The whole point of them is that they've got a fixed pool of assets, and because of that, you can ride volatility in your performance without having outflows of capital, which means you have to sell things at a discount. And so to me, having the system be this kind of frail where someone can buy a big stake and try to take over and have a decent chance of taking over an investment company is kind of a flaw in that whole concept of it being a fixed pool of assets, allowing the managers to go for illiquid stuff, go for stuff that needs long-term investment in. So yeah, it's all a bit weird really. But anyway, in terms of my holding in BlackRock smaller companies, basically there's obviously some sort of underhand backhanded deal going on here of some sort. It all smells a bit fishy to me, but basically for BlackRock smaller companies, and I think some other BlackRock trusts as well, I'm not exactly sure which ones, they have basically got an agreement that we're not going to try and take you over for at least, right, so I mean it's only a couple of years anyway, so it's not that long of an agreement, is it? But anyway, basically they just got some sort of backhanded deal there where they'll leave BlackRock smaller companies alone for a little while. And the one we got yesterday, I think, is Care REIT. I mean, we saw earlier on that Care REIT this week has done really badly, 7.24%. But this announcement, and most of that drop happened before this announcement anyway, because this was only yesterday. But basically, it's just another one of these updates where they just tell you how things are going. I'll scroll through it slowly now, so if you want to read it, you don't have to bother finding it yourself. You can just pause. I read it all yesterday, but I can't exactly remember. Basically, they've had some half decent rent reviews. I think the one thing I want to mention in the video though is that they've kind of they've indicated their target dividend for next year, and if I remember correctly, I think it was, yeah, there we go, 3.6%. They're targeting a 3.6% rise in the dividend for next year, which will add up to 7.2 pence. So that's pretty good. So I'm not quite sure exactly what the market's problem is with Care REIT. Something that's yielding, I mean, obviously I've got it, the real yield, without my pessimistic overlay, is here, there we go, 8.79%, with a 3.6% rise in that dividend penciled in, or hoping for next year. Seems pretty cheap to me, but obviously, you know, the market has proved right so far, hasn't it? Since I'm losing by 8.53%. Anyway, we'll see longer term. I mean, it's probably just interest rates. They tend to be all about interest rates with these REITs. If they go down, the price of it will go up. All right, folks. So I'm a bit late in covering this, but basically Vanguard have introduced, for their brokerage service, they've introduced a minimum monthly fee of £4 a month. So that means the lowest amount you'll pay for the brokerage is £48 a year, and that used to be 0.15%. So if you had £1,000 in there, it'd be a tiny amount you'd be paying Vanguard. And obviously it's like they don't want the smaller accounts anymore, because you know that's not going to be very profitable, is it? 0.0015 multiplied by £1,000. So they don't want little accounts that only pay £1.50 a year to them. So obviously they've changed their fees, and then obviously now people are kind of looking for alternatives, looking to leave, and some people are probably, I think, are like quite upset about it. So I mean, it makes sense because they think when they look at it as a percentage of their portfolio, so if this is the portfolio side here, as a percentage of the portfolio, it can be very high. You know, if you've only got £1,000 in there, it's 4.8% a year of your portfolio. I mean, for most people, that shouldn't last long, should it? Because you should be regularly investing and growing your fund, and then the percentage goes lower and lower and lower, down to 0.15%. And then obviously it hits the maximum, and it goes down and down and down as a percentage. But to me, I don't think percentages are the right way of looking at it anyway. I think what you should do is look at the amount of money, because you know fixed rate brokers exist. You know, there's Interactive Investor. With iWeb, you just pay £5 a trade, but you know a lot of people that's not suitable for, because there's no regular investing. You have to go in there and execute the trade yourself each time you want to make a buy or a sell. So that doesn't suit really, but you know that could be very cheap if you're like me and you're ad hoc. If you're very like dedicated and you will definitely remember every month you'll log in and do a buy, that could just be £60 a year if you just bought one fund, which obviously, as you can see there, is very cheap. Anything above 40 grand in the account, and it gets cheaper and cheaper and cheaper compared to Vanguard, which goes higher and higher until you get to 375. So to me, there's lots of talk about, oh, if you've got a low amount in your account, make sure you leave Vanguard. But to me, it's just as important to do the opposite and leave if you've got a decent amount in there, because it gets more and more expensive. Because the cap of 375 to me is quite high. I think even Interactive Investor, I think, is quite a bit cheaper than that. I don't actually know how much they charge anymore, to be honest, but I think when I last looked, it was 120 quid a year, and that would give you one trade a month as well. To be honest, that was a long time ago though, so it's probably gone substantially higher since then, to be honest. So it can be as low as £4.99 a month, but then above 50 grand. So it's 60 quid below 40 grand. Sorry, below 50 grand, wasn't it? Yeah, below 50 grand, it's 60 quid a year. Pretty similar to Vanguard, really. But then when you get above 50 grand, so up to 50 grand, Interactive Investors, it's complicated, isn't it? It's like it's going to go from one to the other and then back to the other, depending on the amount you've got invested there, I think. But yeah, so then the fees go to £11.99, £143.88. Yeah, so 100 grand and more interactive investor becomes cheaper. And then obviously the later you go. So obviously, the optimum solution in these things is to just transfer from one broker to the other as you go through life and your balance gets higher and higher. And the optimum solution is probably some sort of sequence going from one to another, maybe 3 or 4 moves from broker to broker throughout your lifetime. That's the optimum solution, but most people can't be bothered with that, and they'll just pick one that's decent for their whole life. And if you want to go for one that's decent for your whole life, in the long term, the overall cost saving one is to go for a fixed rate one, because obviously the trajectory of your balance is going to go higher and higher. So if you want to get the best value over a lifetime without changing every few years or every 10 years, you're best off probably going for a fixed rate one like Interactive Investor, which seems to be charging £143 a year. I mean, me personally, I'd rather pay 60 quid a year with iWeb. If that's, if you're just kind of doing a standard once a month buy sort of thing. But obviously, if you've got multiple accounts, obviously SIPs are expensive with iWeb. But yeah, anyway, this video isn't about which broker's best particularly. It's about people wanting to switch away from Vanguard. And my point is they shouldn't really care. They should also care about the higher amounts, because they're thinking about it in percentage terms when they don't need to think about it in percentage terms. They can think about it in pound terms because fixed rate brokers exist, and the top rate there of 375 is quite high compared to some of the fixed rate brokers. But anyway, that's kind of beside the point. So there's a lot of people on Reddit who, especially in the Fire UK subreddit, I think the standard advice there is kind of go for Vanguard All Cap fund, this one here, because basically it's everything. It's the whole world. It's the whole world. There's nothing's excluded. It's all emerging markets, developed world. It's got smaller companies in as well. So it's kind of like the default no decision tracker that you can put all your money in, and there's no decisions being made. So it's a good default fund. If particularly for these lower amounts, if you want to get that 48 quid a year down, the main choice really is like Invest Engine or Trading 212, because they're zero fees. But obviously they only do ETFs, they don't do open-ended funds, which is what this is. It's an open-ended fund. And if you go searching on Trading 212, there's no ETF that's equivalent to this. If you search for All Cap, the closest we get here is ESG Global All Cap, which some people might like. But if what you're looking for is the no decision default whole world, the ESG bit is a decision that you're making. And people who don't want to make decisions and just want to own the whole world, that's not going to be suitable for. So if you care about ESG stuff and you like the way they're implementing the ESG stuff, I guess that's an option. I don't actually know what the charges are. Let's have a look, shall we? I've never actually come across this fund before. I'm going to guess it's going to be close to the 0.23 that you get charged on the Global All Cap one. 0.24, so it's 0.01 percentage point higher than this fund here. I had a little look last week. I haven't, as you can see here, I only spent about 35 minutes looking into it, so take everything I say here with a pinch of salt. There might be better solutions, or I might have got things wrong, who knows. That's the bit I've talked about already. I've already just said that. All the all caps have ESG in them. And if we look here, Trading 212 only seems to have the MSCI Global Smaller Company ETFs. Obviously, the reason I'm looking for a Global Smaller Company ETF is because the way to kind of approximate that global all cap fund would be to have a global fund which doesn't cover smaller companies, and then have a proportion in a smaller company's global fund. That's the logical thing to look for. So instead of having one fund, you've just got two. But what I found is when I searched on Trading 212, I couldn't find a global smaller companies ETF which used a FTSE index, because the index that this fund uses, the index that Yeah, well, it's both of them. The index that the all cap fund here uses is from FTSE. So if you've got a smaller companies fund from MSCI, we don't know how they'll match up with a non-smaller companies fund, this is kind of the default to VWRP for the accumulation version, VWRL for the income version. So this is the Vanguard one, which is kind of the same as this, but without the smaller companies. That's kind of the standard one that gets suggested or recommended. But if you were to match that up with an MSCI smaller companies one in an attempt to approximate this fund, there's probably I don't know for sure, but I'm guessing there's going to be some inconsistencies there. There might be companies that appear in both. They could be at the bottom end of this one and at the upper end of a smaller companies one from MSCI, because they're two different index providers. They might create their indexes using different criteria. So if you want to use Trading 212 to approximate the Global All Cap Index, it would probably make sense to have an MSCI Global Tracker ETF that doesn't have smaller companies and match it up with an MSCI Smaller Companies Global ETF. So then I started looking at MSCI Global Trackers, and I quickly realised that when you find ones that say MSCI World, that is not the whole world. I've worked out that excludes emerging markets. It's just stupid naming. And then to actually get one that covers the whole world, it doesn't have, maybe the W stands for world, I'm not sure. But MSCI, I think people say ACWI to pronounce that as a word rather than an acronym. But yeah, that's what you need to search for. MSCI ACWI, ACWI. That's how you get a global tracker, which is an equivalent to this one here. It's the FTSE All World equivalent, but created by MSCI. So that's how you find that one. And then, so I'm presuming if I search for MSCI ACWI, it comes up with a few options there for a tracker. So obviously, if you're in the UK, you'd probably want to go for one that's on the London Exchange and in pounds or pence. So yeah, that one there probably does the job. That one there, I'm guessing iShares are pretty good, so I'm guessing they'll have pretty good fees. Let's have a look what it says here. So not necessarily a recommendation here. I don't know that much about this fund, but 0.2 ongoing charges is actually a little bit lower than the equivalent one from Vanguard here, or from the FTSE All World, 0.22. So yeah, slightly cheaper. So yeah, I've no idea if that's the best one, but if you want to do it, that's the index to go for, is the MSCI ACWI. Just for the sake of working out what portions we'd have the smaller companies one with compared to the rest of the market, I found this link here. If I press Control and tap on it, it should take me there. I found this. Ideally, it would be nice if there was just an ETF that tracked this index, because we can see here, this index here includes it all, and it also includes mid and small cap as well, as we can see there. So this is the equivalent to the FTSE Global All Cap. This is MSCI's equivalent, and we can see here that this fund here covers 99% of the global investment opportunity set. So I presume they exclude that 1%, probably because it's not liquid enough. I don't think there is a fund which includes that last 1%. Sorry, I don't think there's an index which includes that last 1%. So that's the ideal, is to own that. But then if we look at the MSCI ACWI information, which I've got here, it says here that this index covers approximately 85% of the investable equity opportunity set. So I think we can use that data there to say that if you wanted to replicate the all cap fund, you would want 85 divided by 99, you'd want 85.89% of it in the main fund, which is this one, the MSCI ACWI fund, and then you'd want the remainder in a global smaller companies fund. I think that's how you'd do it. Obviously the problem is those percentages over time will fluctuate, won't they? So when you start having a two-fund portfolio, you have to then monitor the proportions and correct it every now and again. So this is why people really like just having this one fund. But yes, I was just talking about a 2 fund there, but actually I don't think it's possible in trading 212 because I looked for the global smaller companies ETF and I found the only one I found is this one, MSCI World Small Cap. As we know, the word world in the MSCI world does not mean world. It means excluding emerging markets, which is annoying. And then, as we can see, I've written here, there does seem to be an MSCI Emerging Markets Small Cap Fund. I guess the way to replicate the All Cap Fund would be to have 3 funds. It'd be to have a MSCI World Small Cap, MSCI Emerging Markets Small Cap, and an MSCI ACWI. 3 ETF portfolio that should approximate the All Cap Fund. And then every now and again, go in there, check the percentages, look up the percentages on these fact sheets here. I think this one's... When's this one from? Is there a date on this fact sheet? I presume it's just December 31st, this. So each month, I presume this fact sheet here would get updated by MSCI. And you can just come in here, check the percentage. And if the percentage has changed a lot, check your percentages, obviously, because they'll fluctuate. And just kind of match it back up again. You can probably do that in a pie. If you've got a pie, you can set the new percentages in trading 212 and then just click on the rebalance button. So here's my one pie. So instead of having loads of holdings here, you just have 3 holdings. You can then set the percentage for the 3 holdings. You go into edit pie. You can just correct the percentages to what they are each time you want to rebalance it, and then you confirm it. I'll just close it though, and then you click the rebalance, and it'll get you back to the percentages that you've worked out. You know, as with all these things, it's completely up to you how much effort you put into it, really. So if you can't be arsed and you just want to keep this fund, just pay pay these fees, and then make sure you switch to the most appropriate broker when the value of the portfolio gets high enough. But yeah, so let's have a look actually, just to show which funds would be appropriate. So we've got two options here, or well, more than 2 probably. You've got the Spider, I think that's Spider SPDR. You've got a Spider one there. You've got an iShares one there for MSCI ACWI. Sorry, well that's the Euro one. So we'd want to go for the London-based ones in pounds. Well, that's pence, isn't it? So that'll be the one to go for there. Then have the MSCI World Small. So let's look that up. World Small Cap in pounds. So that's probably one that we can go for. I wonder what the charges are for this one. Let's have a look. Yeah, so it's a bit higher, but so I guess it's a higher charge at 0.35%, but it's a small portion of your portfolio, and you're paying slightly less as well, aren't you? For the you're paying 0.2 rather than 0.23 for 85% of your portfolio. So you'd have to do the maths. It might end up cheaper. It might end up a bit more expensive. Not exactly sure. And then if we look up, what was it? MSCI Emerging Markets Small, and there's a HSBC one. Oh, and that one's only view only because it's not a UK one. Oh, that's ESG, so that's making a choice again, isn't it? So I guess we're stuck with the Spider one. Which one's London in pounds? Yeah, that one's London in pounds. So yeah, there isn't really much of an option there. And you'll have to forgive me. I haven't bothered to work out what percentage the smaller companies are emerging markets. I'm not exactly sure how to work that out, and I can't be bothered to be honest. What are the charges? Yeah, see, that's much higher. But I'm guessing even of that 15% in smaller companies, I'm guessing it's going to be a pretty low percentage that is of that 15%. I'm guessing it will be quite a low percentage in emerging market smaller companies. So yeah, a bit of an arse ache, really, isn't it? To replicate fully in trading 212 this. I've no idea. I don't know if there's any extra options in Invest Engine, for instance. Who knows? It would be great if Invest Engine just had a fund that tracked that, or well, you know, even better, that just tracked that index. I don't know. But yeah, for trading 212, looks like a bit of bother. You might prefer just to exclude the emerging market smaller companies, maybe. I don't know, because that's going to be a small percentage. So I guess the choice is yours. You can have one fund that excludes all smaller companies. You could have a 2-fund portfolio that excludes emerging market smallers, or you can have a 3-fund one that has all three, and you just have to keep working out the percentages. And probably overall the cost might be a bit higher because this is quite a high cost one, isn't it? See that one? Yeah, that's the one. 0.55%, quite high. Anyway, there's a kind of a pointless topic for me to cover. Alright, so I think that's it for the week. I'll see you next week. Bye. Bye.